Hey everyone, welcome back to Beyond the Bottom Line. I'm James Troy, an entrepreneur and student studying accounting and data science. If you're a small business owner and you've ever looked at your financial statements and wondered, where did all my cash go? Well, then this video is for you. Today, I'm breaking down the cash flow statement, what it is, why it matters, and how to create one using step-by-step using real examples. By the end of this video, you'll be able to prepare a cash flow statement for your own business without needing to look anything up. Let's get into it. The cash flow statement tells you one simple but crucial thing. Where did all of your business's cash go? Unlike the income statement, which includes non-cash items like depreciation, or the balance sheet, which shows a snapshot of your financial position, the cash flow statement focuses only on actual cash that moved in and out of your business. This is important because a profitable business can still run out of cash and fail. You need to know if you're actually bringing in and keeping enough cash to operate. The cash flow statement has three main sections: operating, investing, and financing activities. Here's what goes into each one. Operating activities. This is cash from your day-to-day operations, things like cash received from customers, payments to suppliers, rent, payroll, and taxes. This section adjusts net income for non-cash expenses and changes in working capital, but more on that later. Second, investing activities. This covers cash spent on long-term assets like buying new equipment, vehicles, or property. It also includes cash received from selling assets. Third is financing activities. This is cash related to how you fund your business. Loans you take out, loan repayments, and money you put into or take out of the business. When we reconcile each of these activities, we're left with a net cash inflow or net cash outflow, shown on the bottom. Let's go step by step and build a cash flow statement using an example. Alright, let's say we have a small business, Pete's Coffee Shop. This is Pete's income statement. You can see the coffee shop's revenues, expenses, and net income. And here is Pete's comparative balance sheet. It shows us the coffee shop's assets, liabilities, and equity as of December 31st. We're using the comparative balance sheet so that we can find out the changes in each account over the course of the accounting period. Before we begin, here are some key facts that happened during the year. Pete's Coffee Shop bought a new piece of equipment for $50,000 and sold the old equipment for $10,000 in cash. The equipment had an original cost of $25,000 and was fully depreciated at the time of sale. This resulted in a $10,000 gain because the sale price exceeded the carrying value of the asset. We can find this gain on the income statement. We also know that there were no other equipment disposals during the year. The business took out an additional $5,000 loan to cover short-term cash needs and increase its long-term loan balance by $20,000 to fund new equipment purchases. Additionally, the owner invested an additional $5,000 into the business to fund expansion. Now, let's get started building our cash flow statement. At the top, we list the company name, the name of our financial statement, and the date. Now let's start reconciling our cash flow from operating activities. We start with net income. Net income can be pulled directly from the bottom line of the income statement. We can see that during the year, Pete's Coffee Shop made $97,000 in net income. Next, we adjust for non-cash expenses like depreciation, amortization, and depletion. We add them back because they show up as an expense on the balance sheet and lower net income, but the business doesn't pay cash for them. And in this financial statement, all we care about is the net change in cash. In this example, there was no amortization or depletion, but Pete's Coffee Shop did record $30,000 in depreciation expense during the year. So let's add that back to net income. Next, we adjust for gains and losses from asset sales. If you had a gain, you subtract it because it was counted in net income but isn't part of your operations. If you had a loss, add it back. In this case, we had a gain of $10,000 from selling our old equipment, so we'll subtract $10,000 on our cash flow statement. Finally, we adjust for changes in working capital. Working capital is the difference between a company's current assets and current liabilities. In this example, ignoring cash, we have accounts receivable and inventory as our current assets, and accounts payable and short-term loan as current liabilities. Over the period, accounts receivable increased by $5,000 and inventory increased by $10,000. So how do we record these changes on the cash flow statement? I like to think about it this way. If your assets are increasing, then that means you paid cash in order to acquire more of that asset. If they decrease, then you received cash from selling assets that you previously had. So in this case, we're going to subtract the $5,000 and subtract the $10,000. Our liability accounts work the opposite way. If your liabilities increased, that means you borrowed more cash. And if your liabilities decreased, it means that you paid cash back to the lender and your cash balance decreased. So let's add the $5,000 decrease in accounts payable and add the $5,000 increase in short-term debt. Now if we reconcile each of these amounts in the operating section, we get a net cash flow from operating activities of $112,000. Now let's fill in the investing section. This section is pretty straightforward. It deals only with the purchase and sale of long-term assets. Investments, equipment, property, or land are all examples of accounts that show up in the investing section. If you're buying a new piece of equipment, that's cash going out. If you're selling an old piece of equipment, that's cash coming in. A common mistake many people make is thinking that inventory purchases go here, but they don't. We already accounted for that in the operating section because inventory is a short-term asset. So if we look back at the sale of equipment, we received cash of $10,000 from the sale of an asset. This is going to be a positive cash flow in the investing section. The gain from the sale has already been reconciled in the operating section. But we also know that we bought a new piece of equipment to replace the old one that we sold for $50,000. So we're going to transfer over both of these amounts onto the cash flow statement. Looking at the numbers, we can figure out that we had a net cash flow of negative $40,000 used in investing activities. The last section is financing activities. Financing activities involve the long-term liability and equity accounts. Looking back at our additional information, we can see that the business took out an additional $20,000 in long-term debt so that they could finance the purchase of equipment. When you take out a loan, you receive cash, so this shows up as an increase to cash flows. If we take a look at our additional information section, the last bullet tells us that the business owner invested $5,000 in the company over the accounting period. This amount will get added to our financing cash flows. Combining these two entries, we end up with $25,000 in net cash flows from financing activities. A common mistake, thinking interest payments go here. They don't. Interest payments are an operating expense, not a financing activities. Now, all that's left is to total up the three sections, operating plus investing plus financing cash flows, to get our net increase or decrease in cash. So in this example, adding up the three sections gets us a net increase in cash of $96,000. Finally, we do one last small step just to check and make sure that we did everything else right. Add the cash balance from the beginning of the year, and you should get the ending cash balance from the balance sheet. It works. If your numbers don't match, go back and check for missing adjustments. And that's how you prepare a cash flow statement. I know this can be tricky at first, so if you have any questions, drop them in the comments and I'll do my best to help. If this video helped you, share it with another business owner who needs it. Thanks for watching, and I'll see you next time.